Well, hi there. So in this video, we're going to be looking at the second half of this, which is the loanable funds market. As I said in the previous video, there's two of these money markets. One of them is for all the money and one is for the borrowed money. So in this loanable funds market, you've got supply and demand, just like normal. The demand in this case, though, is people who want to borrow money. So it's demanded by firms and by households, and they want to spend that money on consumption and investment. That's why they borrow. It's people don't usually borrow for just because they want to hang on to some cash. So what it's really responsive to would be a change in the real interest rate. So this is the critical distinction between the money market and the loanable funds, is that people when they go to borrow, they care about obviously they care about the nominal, but they really care about the real because that's what determines how much real interest they're going to pay. For the supply, that's going to be people who are willing to loan money. So the lenders. Now, when we think about it in some sense, a financial institution is usually the lender. But where do they get the money from? Right? It's not like banks are just, here's some free money. They get their money from people who deposit it. So we would say that the supply is actually from the savings of households and firms. So this is savers, is one way to think about it, and this is borrowers. Right? And the borrowers are spending it on mostly consumption and investment spending. And they're both responsive, as I said, to that real interest rate. This is a quick review of something we talked about before, is that there's savings investment identity. So if there's more savings, right, we would expect there to be more investment spending. And that's kind of a nice outgrowth of more savings. Now, Keynes called it, though, the paradox of thrift. And that idea is that you want people to save money, you want them to be thrifty, because then that savings gets transformed into investment spending and it grows the economy through more productive capacity. But at the same time, you don't want them to be too thrifty and not spend any of their money, because then all the jobs that depend on consumption spending go poof and disappear. So that's not good. Right? Now, the distinction with this market versus the other market, when we go to graph it, is really that the supply curve is going to look different. And it's going to look like a normal supply curve because people are going to save more, they're going to supply more money if there's a higher real interest rate. That should make sense. Like, as someone who often saves a lot of his money, I would tell you that if interest rates are much higher, I'm much more likely to save money than I am to spend it, because I can go, ooh, I could lend my money out and earn a really high rate of return. So there is a relationship between the real interest rate and the quantity of loanable funds that people are willing to supply. And so we're going to see that as basically a standard supply and demand graph. So we're going to put QLF down here, and then I sub R here. And that R is telling the AP grader that that these people are responsive to the real interest rate. It's a critically important little R right there. So we're going to have a downward sloping demand for loanable funds, because as interest rates are really high, people don't really demand to borrow very much because it's very expensive to do so. At the very low rates of real interest rate, way down here, people would increase their quantity demanded because it's relatively cheaper for them to borrow. At this side, we have a supply of loanable funds. And again, at really high real interest rates, people are willing to save more, and that puts more savings into the system. At low interest rates, down in this part of the graph, you have the opposite effect. So we'd say here, Q star, IR star. Right? So that's our general market. Now, as I mentioned before in the previous video, the shifters are where sometimes students get really mixed up. So I would say put a list together, make an index card or something, and then you could just quickly flip through it if you need to. The shifters of loanable funds supply. So these are things that could affect savings rates or the amount of money that's basically available to lend out to other people. So I actually don't usually remember all of the specific pieces of this. I just try to remember in the back of my head, like, where is this coming from? Like, these are borrowers and these are savers, right? And this is the supply of loanable funds. So anything that could affect that will move the curve around, as long as it's not a change in the real interest rate. Because if it's a change in the real interest rate, it just moves along the curve. Price doesn't shift the curve, and that would just move you along the curve. But if it's something else, then it could have an effect on this. So the first one would be central bank changes, right? If the central bank buys bonds, it makes the money supply bigger, and that therefore increases the supply of loanable funds. So just so we know, S to the right, that's an increase, right? D to the left, something like that, that's a decrease. So just like before, it decreases to the left and increases to the right. And this would be the reverse as well. I'm not going to rewrite that, but if the central bank made the money supply smaller, it could decrease the supply of loanable funds as well. The second thing that is a common shifter is private households and firm savings rates. So this is the idea of like, if people decide I'm going to just save more money. So it's not because of a change in the interest rate though. It's literally just like something cultural happens to cause people to decide to save more of their money. Could be maybe there's a tax credit for savings, right? If we change our tax code and incentivize people to save more money, then that could increase the supply of loanable funds or decrease it, right? So that's something to kind of think about. Changes in inflation or inflationary expectations. This is kind of a tricky one because it requires you to think about like, what would that do to people's savings? Well, if there's really high rates of inflation, or if I expect there to be, I'm probably not going to lend out lots of my money for two reasons. One is that I'm going to need that money for myself. I'm going to need it to do my own transactions. And two is I'm not as excited about the idea of lending money to people in periods of high inflation because it erodes the value of my loan, in the sense that they're repaying me with money that's worth less. But the bigger issue is really that I actually need more of the money to do my own transactions with. So it's literally harder for me to save. The last one here requires you to think about the big picture a little bit. And this is the idea that, and we call it capital flows. It's a fancy way of saying movement of money across borders, across international lines. And basically, if you can imagine two countries, right? One that's domestic and one that's, some foreign country. So we could say, if we're from the United States, we would say US and Canada. And if the domestic interest rate, right, this real interest rate is larger than Canada's, right? If the US rate is 10% and Canada's is 3%, then the people in Canada will move their money over to the United States and try to lend their money in the United States. And there's ways that they can do that, but it's called an international capital flow. The Canadians go, gee, we could get 10% in America, why don't we do that? So they move their money over to the United States. That increases the supply of loanable funds in the United States. At the same time, the Americans, right, who have loanable funds, who are saying to themselves, well, I can put it in Canada or I can put it in the United States, they're going to take their money out of Canada and lend it in the United States, and that therefore increases the supply of loanable funds for the United States. So both of those actions happen simultaneously. The reverse also happens back in Canada, right? When they're moving their money out of Canada and when the Canadians are putting their money in the United States instead of in Canada, then the supply of loanable funds in Canada drops. And eventually those two interest rates, the 10 and the 3, will equilibrate in between. Now, we don't know exactly where they will be. It won't necessarily be right in the middle because we don't know the size of the relative capital flows. But what we can say is that they'll kind of reach somewhere in between if there's a free flow of money between the two countries. So that can affect the supply, right, of loanable funds. Let's talk about the changes in demand. So the first one is changes in perceived business opportunities. And this is the idea that like if businesses are like, woohoo, things are going to be rocking and rolling next year, they're going to want to borrow money today to finance expansion of their operations. So you might see questions like that. You might see something that starts with like, there's a tax credit for businesses to expand or something. Anything that's going to make them want to expand their businesses and things like that, they're going to need borrowed money to do that. So that would increase demand for loanable funds. Another second shifter here would be changes in government borrowing. So if the government starts borrowing, this is one's really, really important. It's going to show up on AP tests a lot. If the government borrows money, they're going to demand loanable funds. And we've actually talked about this before because we talked about it as crowding out, right? The 800-pound gorilla going up to the crab legs in the Chinese buffet and eating them all, pushing everybody out of the way beforehand. That's what this means, is literally, they push everybody out of the way. And so therefore it decreases the amount of private borrowing that can happen. So there's actually two ways that we can model this. And without getting kind of too technical, you can actually make this a decrease in the supply of loanable funds, because really another way to think about this is that the government is vacuuming up the supply before it even hits the private market, right? Because they're kind of the borrower of the first borrower. They get their pick of the litter. So everybody else is like stuck with less supply of loanable funds for them. And that kind of nicely illustrates, if you decrease the supply, it illustrates the idea that there's less loanable funds out there for mom and pop stores and for people like you and me to borrow money. At the same time, either way, right, a decrease in supply or an increase in demand, because that's really what it is, push up the interest rate. And that's really what we kind of are looking at in this model, is what happens to the interest rate when this happens. The last thing here is actually a duplicate of up here, changes in inflation or inflationary expectations. And by the way, you would only have to write one of these two. So if you got a problem that said price levels went really, really high, how does that affect loanable funds? You could just pick one. You don't have to do both. But in short, if it helps you to just remember it this way, if there's much more higher prices, people are going to demand more borrowed money in order to finance their purchases. And so we would say that, there would increase the demand for loanable funds. So again, just pick one and just remember only one. You don't have to remember all. Okay, the last thing is what we call long-run money neutrality. We're going to come back to revisit this idea a little bit later. So let me kind of skip ahead to this idea. This is the idea that in the short run, the money supply changes could affect output, right? We know that they can change the interest rate and push down the way I think about it is a rubber band between two spokes. So they push down on that rubber band and the interest rate goes down, and that promotes more consumption and investment spending, right? That's the interest sensitive spending. But in the long run, that rubber band will just go boop right back up to where it was. And that's the idea that interest rates aren't really affected by the supply of money in the long run. And this is kind of weird to ponder, but here's why. So if you increase the money supply and push that interest rate down, the consumption and investment will go up, sure. Aggregate demand will go up, sure. But prices will start to rise. And when the prices start to rise in the economy, there will be an increase in money demand that pushes the interest rate right back up to where it used to be. So there's multiple mechanisms here that would make it so that the interest rate is kind of not really related to the amount of money in the system, because the money demand curve will move back and forth to get you back to like an equilibrium level of an interest rate. So there's a great amount of research done on like how really effective are central banks. Can they actually really affect interest rates in the long run? And if there's an increase in price levels, demand will push up that money demand, and the interest rate will go right back to where it started again. So this is something we'll kind of return to later on in this class as well. All right, hopefully this helped you. See you next time.